Washington, D.C. In remarks likely designed to emphasize the Federal Reserve's single-minded emphasis on battling persistent inflation, Chair Jerome Powell suggested Wednesday that the Fed will raise rates higher than initially anticipated and maintain them there for a long time. In addition, Powell hinted that the Fed might only raise its benchmark interest rate by a half point at its December meeting after 4 consecutive three-quarter-point hikes in a written address to be read at the Brookings Institution. Powell also emphasized that the modest boost shouldn't be interpreted as a hint that the Fed will soon give up on the fight against inflation. Powell noted that there has been some good news on inflation, as prices for items like vehicles, furniture, and appliances have declined. Additionally, he predicted that housing expenses, which account for nearly a third of the CPI, will likely decrease in the coming year. But the price of services, such as eating out, traveling, and receiving medical attention, is still rising quickly and will probably be far more difficult to control, he said. Powell stated, despite these encouraging signs, we still have a long way to go in restoring price stability. According to him, the lack of workers is due to an increase in early retirements, the COVID-19 epidemic that killed thousands of individuals in their working years, a steep fall in immigration, and slower population growth. According to Powell, wage growth is still substantially above levels that would be consistent with 2% inflation over time. According to the inflation report from last month, prices jumped 7.7% in October compared to a year earlier, which put a burden on many families' finances. However, it is down from a peak of 9.1% in June. The Federal Reserve increased its benchmark interest rate 6 times this year, bringing it to a range of 3.75% to 4%, the highest level in 15 years. These increases have driven up the costs for the majority of other consumer and business loans and sharply increased mortgage rates, which have decreased home sales. Officials at the Fed believe that by restricting credit, they can lower hiring and wage growth, slow inflation, and cut down consumer and business expenditure. Powell said that despite the Fed's efforts, demand will need to remain subdued for a protracted period. The Federal Reserve raised interest rates by a hefty 3/4 of a point at its most recent meeting in November. However, Powell indicated at the time that the following increase would probably only be a half point, still a significant improvement. Interest rates are typically adjusted by the central bank in quarter-point steps.